Okay, so before we can really talk meaningfully about the different types of business finance, I think it's essential that we all get on the same page in respect of accounting. And you might think to yourself, well, hey, I'm a chemical engineer, I'm a microbiologist, I'm a computer scientist, why the hell should I know anything at all about accounting? That's going to be somebody else's job as I start this business. And yeah, that's true to a point, but when you start to talk to investors, what you'll find is that almost all of these guys have got a finance or accounting background. They're chartered accountants or CPAs or finance MBAs or ex bankers. In short, they know accounting and finance inside out. And they're going to expect you to have at least some grasp of it. So let's kind of take a bit of time now and give you at least a grip of the basics. And I'm going to do this by using this entirely made up company. And what we have on the screen here are two types of financial statement. So on the left here, and on the right over here, we have what are called balance sheets. In the middle, we have something called an income statement, or if you grew up somewhere in the British Commonwealth, you'd probably refer to this as a profit and loss account. So let's talk about the differences between the two. So a balance sheet is always drawn up on a specific date. So for example, you'll have a balance sheet as of the 30th of December or the 25th of May or the 2nd of February. It doesn't really matter what day you draw it up. You can draw it up at any given day. And what this is a snapshot of the company's financial position on that day. And it's governed by something called the accounting equation. And all the accounting equation says is that the total assets of the company, and an asset is something that the company owns or monies that it's owed. These always equal the sum of the liabilities and the equity. So a liability is the opposite of an asset. So it's money that the company owes to somebody else. So whether this is to a bank or to a supplier, doesn't really matter. It's a liability, it's money that's owed. Equity is really a specific type of liability. So equity is really money that's owed to a shareholder. So in this particular case, I formed this company on this first day of the year. And all I did was I took $200 out of my own bank account and placed it into the company's bank account. So what this means is the company now has $200 in cash. So in return for that, the company really owes me $200, which I took in form of ordinary shares. And you can see that this still all balances. So I've got assets here of $200. I've got liabilities down here of $200. So that's really our start. If we then fast forward a year, the income statement really tells the story of what happened during that year. And again, let's kind of go through this almost line by line, so you kind of get a grip for some of the terminology used. So I started off by, as of the end of the year, I'd sold $1,000 worth of stuff, and this stuff had cost me $600. So now it doesn't really matter how that happened. It could be that I just bought $600 worth of goods, I marked them up and sold them for $1,000, or whether I bought some raw materials, added labour, etc., that in the aggregate cost me $600, and then I then sold it. It really doesn't matter. The end of the day, I made a gross profit of $400. I also had what we call operating expenses. So these are, if you like, the costs of doing business. So, in this case, I paid $20 in rent. I paid $100 in wages. I had a $10 telephone bill, and I spent $20 on business-related travel for a total of $150. I can then deduct this $150 from the $400, which then says I had an operating income of $250. And operating income is a fairly useful concept, and it's essentially the money that I make in my normal course of doing business. So what I mean by this is, if I, for example, got a government grant, I'd actually reflect the government grant down here. So let's say I got a $100 government grant. It doesn't change my operating income at all. My operating income is still $250. And the reason for that is that, I'm not in the business of getting government grants. I'm not in the business of winning business plan competitions. I'm in the business of doing whatever my business happens to be. And therefore, my operating income is the income that I get from that, not the total income that I get if I count all of these, if you like, windfalls as well. Now, that said, if I do get this government grant, as far as the government's concerned, it's still taxable income. So I would still add it to my pre-tax income here, which I then pay tax at a given corporation tax rate. And let's just pretend it's 20% here. So I'd pay tax of $68 on a pre-tax income of $340. This leaves me with a net income of $272. And essentially at that point, it's up to me how I decide to spend this money, if you like. So on this particular case, I am going to pay myself a dividend, essentially a reward for me being a shareholder of $100, which then leaves me $172 to invest in subsequent years. So, essentially, this gives me a $172 head start on next year. So we'll finish up by talking about, the final balance sheet, which essentially is, if I start with the opening balance sheet, I add up all the effects on the income statement, it leaves me with my closing balance sheet. And let's sort of be specific here. So I started up with $200 in cash. I've added $172 in cash from my operation during the year, which has left me with $372 as of the end of the year. On the other side, I've only got $200 in shares, and at the end, I've still only got $200 in shares. So where's the rest of the money? Where's the other $172? And the answer is that's the retained profit that I've got from the year. That's that head start I was talking about just now. So you can see these numbers match up. Now you might be wondering, well, this is all very convenient. We can see this, but what about real companies? Real companies typically do business on credit. So for example, if I sell you something, I might get paid 30 days later, and if I buy something, I might have to pay that supplier 30 days later. All of those things, so money I'm owed would count as an asset, so would be reflected kind of up here somewhere. But, for the purposes of illustration, I'm kind of simplifying this a lot. We don't really need to consider the difference between cash and accrual accounting at this point. It's not going to add anything to the discussion. So let's keep things simple. So hopefully you've got at least some understanding of what number changes what other number. So I'm now going to move on and talk about the different methods of financing the company.